end of year, people are busy.
Yeah. Always fun when you get on early because you want to be prepared and you just sit here in silence.
Stare at each other.
Just wait.
We're recording too, so.
Yes, it's great. That's why
It's
I stopped
okay.
talking so
We'll
much.
cut this part. We'll cut this part.
Okay, good.
The
Marjorie,
good news is we have two colleagues that aren't on the phone who like to talk before we get started. And it's like, we can't have that on recorded, guys. No.
Yeah, no. Yeah, we Marjorie and Amy, who Marjorie's our marketing person and Amy is our video person. They will make this very pretty. And
we will have a nice open and we can cut out anything that is untoward.
Good.
including just awkward conversation as
Yeah.
we wait.
I'm spinning around going, what is it I'm supposed to say?
I can still
I got
hear
very-
the chirping. Back at that somewhere up there, something's
Oh.
chirping.
I can't.
I
hear it.
can't hear it.
I can't hear it either.
So
It's
As long as it doesn't go full blare, you shouldn't hear it. But if I start twitching, you know why.
if you get up and run away and I don't know, you're just like suddenly we get reports of someone in Virginia throwing their fire alarm like into the front yard.
Yeah. All right, so it's 1 o'clock. We'll give it another couple minutes. People are starting to log on, which is great.
Mhm.
And we'll give it a couple minutes and we'll get started. For those of you who just joined us, we're going to get started here in about 2 minutes. All right, it's 2 after the hour, so we're going to get started. Welcome everybody to the Transportation Energy Institute's webinar on vehicle policy and market developments. This is a second part of a kind of a series. Back in May, the TEI Board of Advisors said, hey, we'd love to do some research on long-term implications of recent U.S. federal policy developments. And when we looked into a little more intently, we said, you know what? Writing a white paper when the situation is changing so quickly and so frequently would be a complete waste of time. So we decided to do a series of webinars. We did one in September on the impact of biofuel policy. And today I am thrilled to have Stephanie Brindley with S&P Global Mobility and Stephanie Valdez Streaty with Cox Automotive on the webinar today, because they know a lot more about what's been going on policy in the vehicle market than I can ever pretend to know. Thrilled to have both S&P and Cox Automotive on our board of advisors helping guide our directions and what we do as an organization. So I have a couple, I have some slides I want to get up here, so let me get that up here and share my screen with everybody. So today's presenters, I'll be your moderator. I'm not going to talk a whole lot other than ask questions of the smart people on the call. Just in case you're new to TEI, we've been really developing a much more comprehensive and diverse list of stakeholders. Our board of advisors come January 1 is 68 individuals, and you see here a range: major oil companies, EV charging companies, vehicle engine manufacturers, fuel providers, distributors, equipment providers, public health representatives, you name it, everybody's at the table. And the reason we do that is we really want to be as objective and as unbiased as possible. And we all come with our inherent biases. So we've put together this board because this is the board that decides what we study, and they peer review all of our publications. I guarantee you, if there's something biased in a report, somebody on this board is going to find it and help us fix it. So I'm really pleased with the way we developed going into 2026. We have a lot of momentum, really good stakeholders at the table, and I'm excited about what we're going to do next year. But with that said, let's get into it this year. And I'm going to try to be as clear as I can when I'm referring to Stephanie and Stephanie. I may change my name, so it's just the three Stephanies, but it's just, I'll try to be very clear. We have worked on this and gone through, and so we're going to look and have a defined agenda. So the description you saw in the invitation is we really want to take a look at what's going on. What are the policy and what are the market responses to policies? And, in a pre-call, we said we're going to look at 4 major categories, and we've divided this up into different people to talk about each one. So we're going to talk about CAFE regulations and the Inflation Reduction Act. Then we're going to talk about electric vehicle incentives, tariffs, and then what's going on in other jurisdictions, California, Canada, European Union, China, to see what the global implications are. After each section, we're going to talk. So we've asked one of our guests to speak on each one, and then we're going to have a conversation after that. So if you have any questions that you want to ask, please post them in the chat or raise your hand. I'll ask Liz to help kind of keep track of that since it's on a different screen and I can't see it very well. But with that, I'm going to turn it over to Stephanie Brindley to talk about corporate average fuel economy and the Inflation Reduction Act. So Stephanie, it's all yours.
Well, thank you. Let's okay, there's my first slide. I've just put together a couple of slides to kind of touch base on what this actually is versus how it was presented in some cases. And I'll make statements about the different administration approach, but it's not necessarily meant to be a judgment of what's right or wrong. I'm just going to try and describe what happened. And what you have now is, as the Trump administration looked at it, and they used language like the Biden administration factored EVs and we didn't. That's not precisely true. But what they really wanted was lower fuel economy standards. And I think there's a tie into the IRA as well, in the fact that one of the things the Trump administration has talked about doing is reducing regulations in general. And that is part of what happens in here. One of the things that they're proposing is reclassification of vehicles and having some small sport utility vehicles kind of reshifted into passenger car. For CAFE calculations, that will be interesting to see if it comes through. It goes back to kind of where vehicles were initially categorized and where they were initially expected to be when this regulation was written in like 1977. At that point, a light truck really was a work truck, and that's what it was intended to be. We've moved past, and there's a lot more blending, and so the administration has said, well, let's go back to kind of what the original intent was. But the effect will be that passenger cars will have larger, thirstier utility vehicles in them, and light trucks will be a smaller part of the segment, but they will have fewer smaller vehicles than full-size vehicles. And so it'll be more difficult for both segment to meet CAFE. The balance as a CAFE is much less stringent than it was before. The lower slide is what we have currently in place. The lower chart and the upper chart is where the Trump administration wants to go with this. Carryover conditions, there's still footprint race compliant curve. And the actual definition of whether somebody is compliant with their fuel economy regulation and what they need to be isn't this number that's on the screen. It's what the target curve gives them specific to a vehicle, specific to their fleet. But this is a representation that gets used to explain it. You'll notice both versions, the current rule and the proposed rule, what NHTSA expects can be achieved is always much higher than what they show is required. And that's just how it works. They find the math to make it be what they want. And that math has a lot of suppositions behind it. It has mixed suppositions behind it. It has technology suppositions behind it on both. But the methods and the formula for actually determining that target footprint aren't changed. Some of the numbers going into it are changed. Efficiency for fuel economy is still on the 2-cycle test, where NHTSA uses the 5-cycle test on the Monroney label. So what you're actually going to see as a consumer coming in is something lower than what's up there, just because of the way that it's calculated is a little bit different. The DOE PEF values, petroleum equivalency factor, does still in play. If you've got an electric vehicle or if you've got a plug-in hybrid with electric operation, there's some math. That vehicle gets counted in your CAFE and it gets counted in that knockdown. So it's not actually true that building battery electric vehicles don't matter to CAFE anymore. They actually still do. Next slide. All right. So some of that in there, what we have looking at it, and on the side, the regulations, the new proposed, you can see is much less stringent. Current CAFE regulations are 2% year over year, and light truck has had a little bit of a gap, but then it's 2%. These numbers are just much lower. The target is much lower. The regulations are retroactive to model year 2022. The reason this can happen is because NHTSA determines if a company is compliant on a 3-year backward basis, basically. And because this makes it a little bit easier and those vehicles were already produced, they're able to do that. Going forward, the big changes are 2028 model year and forward, because on the flip side, if you're making it more difficult, you have to give an automaker 18 months to the model year to be able to make changes. So the new changes, the more impactful ones, start with 2028. That is changing the criteria for light truck. That's ending trading credits between automakers, so you can't buy credits from Tesla to offset a big truck. Can't do that anymore. Off-cycle credits also end. That would be getting a credit for an air conditioning unit that is more efficient, and then therefore putting less strain on the engine and therefore improving your fuel economy in a way that doesn't get measured. So all of those changes start with model year 2028. The other question that we were getting a lot when this first came out was, does this, with NHTSA IRA, one of the things that was changed actually with the One Big Beautiful Act is they reduced the fine for non-compliance to $0. It's not actually gone, which means policymakers could change that number again. It's just dropped to 0. So the question is, if it's there's 0 fine for compliance, do these numbers really matter, and why try? One of the answers is that it can't change, and nobody wants to be stuck with it changing as an automaker. The other one is tier 4 criteria. Pollutants still is a factor. There's current regulation on that is 2027 to 2023, or 50% drop in various pollutants. And this is the NOx, this is the particulate matters, this is not greenhouse gases, which is the CO2. We do expect that EPA will stop, that will retract the Endangerment Act and probably stop the CO2, but we don't think the tier 4 is going to go away. It may get reduced, but that one ties into fuel economy, because better fuel economy, the lower particulate you have. You still have to meet that. You're still going to have to put a particulate filter on your engine. That's still going to cost money. Penalty for non-compliance with EPA is fines, permit revocation, orders for corrective action. You don't get to sell if you really mess up being compliant with EPA, where NHTSA is as a fine. and it's a little bit more simple. Of course, we all remember the poster child for not messing with the EPA would be the diesel scandal of Volkswagen and the time that it took them to pull out of that. But that's a demonstration EPA does have the ability to stop you from selling. And we can go on to the next slide. One of the things that as we talked about, NHTSA under Trump used a little bit of different thought process in their assumptions. Now, one thing that remains true is whatever the administration is, the EPA process or the NHTSA process for determining corporate average fuel economy is actually pretty strict and pretty stringent. The documents from the two organizations two times look the same. You can overlay the language. So there's 4 things that you're supposed to be figuring out when you're trying to figure out fuel economy regulations: technological feasibility, economic feasibility, impact of other federal statutes and regulations that might come into play, and whether or not it saves US fuel. I think that one's pretty interesting because we talk about this as being a way to improve emissions and guide electrification. But the reality is those regulations are written to stop using fuel. Like it's really, at the end of the day, it's related to emissions. So you get the conversation gets muddled, but that is what that's for. Now, under Trump, they didn't put as big a weight on what alternative fuel economy or alternative fuel vehicles could do and how they would be used and what the mix might be within that. Under the Biden administration, they factored in the IRA and what that would do for manufacturing credits and what that did for consumer credits, and all of the things that were in play that automakers were saying they were going to be compliant with California's ZEV mandate, which is now kind of gone. So under the element of being able to factor in technological feasibility and other statutes, it's not clear to me that the Biden administration was wrong in factoring those things in. The Trump administration does not and did not factor all of that in. So you have a much different number. Again, it's not necessarily that one is right and one is wrong, or one's legal and one's not legal. There is some gray area in what you choose to put into your assumption set, I think, is kind of the bottom line of that. And again, BEV and PHEV do still contribute to compliance. So, you know, the remark, oh, you don't have to build an electric vehicle so you can sell an F-150 is not entirely accurate. Those do still have an impact on the regulations that you have to meet. And now we can have some questions. Oh, I'm sorry, I didn't finish the IRA, did I? No, on the IRA, some of that is when I talk about lack of regulations. The NEVI money was pulled for electric charging stations pretty quickly, rolled back in with changes because the Trump administration didn't want as much emphasis on low-income communities and wanted to pull back some of the restrictions there. So now the money is coming back out again and it's being released, but you don't have to have some of the requirements for being able to get to the charger and fix it when it's snowing. You don't have to have some of the city areas and the rural areas to aren't those requirements that the Biden administration had in trying to make sure that we had a much broader infrastructure are not part of it. So it'll be private and policy and sort of where do you need those and let the Trump idea is to let the market figure out where those need to be. Incentives, of course, for consumers went away and that's caused a drop. We'll talk about how that ultimately is going to put these vehicles on a playing field that lets consumers, you know, pay what they're worth and pay what they need to do. Manufacturing credits have changed a little bit, and that has an impact on what you're going to build and where. I think that sums up pretty much what they did to IRA. I think it was interesting. It is a law, and as the Trump administration came in and said they were going to change things, I was curious to see how it would come together. So rather than going after and changing the law itself, they changed some of the criteria and they changed the dates for when things expired, which is a much faster way to have changed and made an impact.
Thank you, Stephanie. So I have a few questions, but Stephanie, anything you want to add to the conversation about CAFE from your perspective?
Yeah, I think we'll just add that, you know, definitely gives manufacturers more breathing room to sell more of those more profitable trucks, SUVs. And then I also think about, we're talking about longer term implications of the carbon credits that some of the pure EV providers had, that's helped with some of their profitability. So you think about Tesla specifically and Rivian, and that's going to go away. So that has some implications.
That's a significant thing. Because I remember you look at the Tesla profitability, and so
Right.
much of it for years
Right.
was based on selling credits.
Yep, that's how they
the
became
others-
profitable for the first time, like way back when. Yep.
Right.
Yeah. And to Stephanie's point too, I mean, it does open up, it takes pressure off automakers. And I think it does give consumers the ability to move this along a little bit at their own pace. I think there's enough demonstrated pushback that consumers are interested in electric vehicles. They are not going away. This is still something to work forward and strive forward. But I think consumers are saying, we'll do it when we're ready. And rather than regulations driven. So I think we're having that little bit of a change, and it needed to. I think another point on the cafe stuff is, regardless of who was in office, the Biden era cafe requirements are not achievable. So something had to give.
One of the things that I'd like to dive a little deeper on is your commentary about removing the compliance, moving some of the light trucks, the crossover utility vehicles from a truck category to a passenger car category. And you mentioned, it makes it a little more challenging to comply, because one of my theories has always been the reason we have such a huge increase in crossover sales. Half of our vehicles in the United States are crossovers because, one, customers like them. Clearly, they like the size, they like the higher ride. The automakers like it because margins are usually a little bit better, but also because they're basically mid-sized cars on a different chassis or a different category, compliance was so much easier. What is that implication? So shifting that definition of light truck and passenger car, what do you guys view to be the real implication on the vehicle manufacturer's ability to comply, and what might that do to the vehicle mix being produced?
I think all of it still leads to a lot more electrification within the fleet, because even though these requirements are easier, there's still requirements, and you're still going to have to hybridize. You're still going to have to electrify to do things. And they've got till 2028 model year to adjust it. We might see some vehicles like RAV4 ride a little bit lower and really be a little bit more efficient. They're kind of artificially had kind of been pushed in this category. NHTSA's under sort of justification for doing this is they looked at the off-road section of those requirements and said, look, if you have to go off-road, or if you're going to be a viable off-road vehicle, you have to have enough of an approach angle to get over the rock. And looked at the actual specifications of what's out there, and their math was that 99% of them didn't meet the approach angle requirement. So they reworked it and changed it around. So that's going to, it's the off-road element of it that's going to knock it back into being a passenger car. But I think over the years, consumers want to ride higher. So I don't see a lot of sales impact for this. I think there's still some difficulty for automakers, might have to be a little bit harder, but again, hybridization will get a lot of these vehicles in that space. Electrification of RAV4, electrification of Rogue, electrification of those will, I think, still get those in the way they need to be, at least on these regulations. But I think consumers personally don't really care if the automaker is compliant or not. That's their problem. The consumers are going to care if they want the vehicle or not. And I don't think it's going to change a lot of consumer buying habits because I think it's pretty entrenched.
Okay. All right, thank you. Let's shift to the next topic on our agenda, which is the change in electric vehicle incentives. I'm really interested in this because when I've looked at the numbers, the percentage of EVs sold without the incentive I think outpaces dramatically those that are sold with the incentive. So really interested to hear, Stephanie, your thoughts on what the implication of these changes might be.
Yeah, so and Stephanie touched on this. You can see on this slide, they pretty much all expired September 30th. And definitely, if you look at the data, Q3 was a record quarter, which we expected, right? Everyone had the rush ahead EV sales. It was about 10.5% market share. And then came October, right? Close to 50% drop. Going into November, we had about 5% drop. We're going to end the year probably about 2% below last year. About, I think that's probably where we're going to end up when the numbers come in, depending on how December ends up. But I think the biggest impact when I look at just the incentives is the leasing, the commercial incentive, because that really was so attractive to consumers and also a very effective selling tool. It provided a lower monthly payment. It provided consumers with, if they're concerned about depreciation, residual value, or if they're waiting for new battery technology. So it was a win-win. And since 2023, there's been over 1.2 million EVs leased. So the good thing about that is those are going to come off lease and enter the used market. So I think we're going to start to see, even though it's like 2% of the used market are EVs, that's going to continue to grow. And I think from a consumer perspective, they're going to have a lot of options at lower price points. And I think it really has a strong value proposition. If you're able to get that used EV close to the price of a used ICE vehicle, you can charge at home, you have lower maintenance. Because at the end of the day, the number one barrier, and we know there's infrastructure challenges, but price, the affordability. The average EV is close to 60,000. I was looking at some data. 61% of the EV models are over $65,000. There's 9 models that are below 40,000 versus 57 models industry-wide or ICE plus. And then 29% of sales, industry sales, are between that 30 to 40%. EV sales 3.7 in that price range. So just highlight that affordability in just general is an issue, but EVs even more so. And so with that 7,500 going away, that makes it more expensive, right? And then I think for the used, the 4,000, that definitely helped increase used EV sales as well, which are still small, but we've definitely seen a lot of growth. And those are up about 36% year to date.
The leasing credit too enabled a lot of vehicles that wouldn't qualify under purchase to be leased.
Exactly.
It opened up, vehicles that weren't produced here. That didn't matter if your battery or critical materials where they came from. It opened up that a lot, and that's gonna make a difference, I think, as well. I did notice as I was looking at November to October that there wasn't a huge increase from October to November, but there were a number of electric vehicles that sold 10, 20, 30 more units in November than October. So it'll be interesting to see how quickly consumers bounce back to that or from that to a degree. It underscores the interest is still there.
Yeah, I definitely think, even depending on the segment and looking at November data, Rivian was up the most month to month. And I think it's that whole, depending on the demographic, it's buying your vehicle, that price sensitivity. So I definitely think we're going to start to see what that natural demand is for EVs the next 6 months. The other thing, the 45X manufacturing credit, that's the other one, the two that I think luckily it's being phased out, but that still creates a lot of uncertainty for the investment. And we've already seen certain projects be canceled or postponed. And that has a ripple effect on suppliers, tier 2, tier 3, jobs. And so I think more to come on that in the next 6 months, year, to see what the actual impact of that is. But that's some of the longer term implications of that going away.
Next slide.
Yeah, and this slide just highlights you can see the dip, right? You go to September and then decline. And it was expected, right? September, you can see over 12%. August was pretty high market share as well. So I think that just shows once again that the pull ahead sales, and now the market's just going to have to figure out, what's going to resonate with consumers. And at the end of the day, the industry just needs more affordable models in different segments. I think that's going to be the biggest barrier. And also, I think we'll continue to see infrastructure, which is also a challenge, right? Access to reliable, easy to use. I think the one thing that was good for the industry is that standardization around the North American charging standard. So for a consumer, right, I want the same experience as when I go to put gas in. I can go to any gas station. It's easy to use. I know how much it's going to cost. I know how to pay. And so we need to have that same experience with EVs. And so I think that standardization will help. The other thing I think is going to help if we have real-time data for charging infrastructure. So, and I think Electrify America has now offered that, but I think that's key because I've heard stories, you go to a charging station, it doesn't work. You're getting low on, charge and you get that anxiety. And so I think that's going to be another critical factor if we want to really get into that middle mainstream adoption, more affordable EVs, better charging, accessibility, and easy to use is going to be critical.
We had our electric vehicle council meeting just a week ago and had a conversation about the availability, and it's reliability, is it functional? But if you're pulling into a station with 10 chargers and they're all occupied, knowing that ahead of time, because you don't want to stand in line for 20, 30 minutes.
Right.
And so understanding that transparency of what the infrastructure looks like could give consumers a lot more confidence going into that. I do have a question. So I'm going to be a very massive cynic here, which is my nature. How much of that $7,500 tax credit was kind of factored into the retail price as an inflationary component, knowing that it was going to come off, that the automakers could charge a higher price in order, knowing it's going to be discounted? And is that possible to get that reversed out? I mean, or is that complete fallacy?
I think the fact that they were all losing money would underscore that that's a fallacy.
Right,
they
right.
weren't making
Right.
money at the prices they were charging. So what the tax credit did was enable them to at least get that far because they knew
Right.
consumers had an offset someplace. But I don't think it really factored into, I can add another $3,000 because I know they get an incentive, because again, they're still losing money on it. So I don't think that was really the focus of that process. It'll be interesting to see what incentives do, or if they just step back and let it be more natural.
And we do have, like, in terms of manufacturing incentives, like, I think it was, I had that written down somewhere. I think it was 11.3% in November. So, manufacturers are still putting incentives on these EVs, and we'll continue to see that. It's, I think the average industry-wide is 6% or something around that. So definitely we're going to continue to see that. But going back to the price of the EV, it's all about the battery. It's 40% of the cost. So that's going to be another thing, just really figuring out how to reduce that price of that battery. And so I think we will continue, from an optimistic perspective, continue to see battery innovation. It's going to go down. I know Stephanie's an expert on tariffs, so that, that's another thing, because China owns the supply chain and there's a lot of that needs to be under consideration. And it takes a long time to build a supply chain around that in the US. But over time, I think we'll get there and we'll start to see that price continue to go down, which it has already.
Yeah, I would agree. I think we will. And I think part of the disconnect on pricing, to me, always ends up being not just the raw price, but the fact that it's $5,000 more than the gas one.
Yeah.
So it's not simply, is it a $60,000 vehicle, because the average price is $50,000. People are finding a way to buy them, to spend money when they want to. And that's been interesting. Consumers have been super resilient through all of this. But I think it's that price delta, and we will see more affordable vehicles coming. And it takes time to develop this. And we're in an environment where regulations were saying we have to do it much more quickly than was practical for building and manufacturing and for consumer adoption of what consumers need to know to make that change. So we're going to see a little bit of correction that way.
The other thing too, okay.
No, go ahead, Stephanie.
I was going to say, and Stephanie probably has a lot of information on this, but the other thing too, just because of safety, other things, there's all these other things that bring up the cost of a vehicle. So it's not just that it's an EV in general, but just cars in general are expensive because of all these other things.
Absolutely. The CAFE regulations are not going to make cars cheaper, by the way.
You both have opined on this a little bit, but I had a question just this morning, which is one that I've been anticipating and heard before. Somebody not in the industry, not as close to the industry as we are. So, all the news is the automakers completely retreating. They're completely abandoning their investments on electrification. The EV fad appears to be over. Now, my response was, no, you need to actually pay attention to what's going on. But you mentioned a couple years ago, the grandiose aspirational announcements of the OEMs. And I always I contrast that to today, where it sounds complete 180-degree switch. I view it more as right sizing. They have the ability to take a deep breath and actually deliver what the customer wants in a way the customer wants it. What's your take on the news cycle today relative to a couple years ago and the reality going forward?
I think it's settling down. I think right sizing is a better look at it. I think when we had the hype cycle, I think part of the hype cycle was regulatory driven in all markets, not just the US. And that was pushing it. Wall Street wanted to see you invest. They wanted to see that conversation happen. And so it happened. And it was a little optimistic. Everyone who said they were going to meet this and that target always said market dependent. So, the automakers were keeping an eye on this. And some of those regulations, what kind of happened too, and the US going back to the Paris Accord and all sorts of policy things happening around the world, going into all of that in 2019 and 20, the conversation was, how do we figure out where to split the money? Do you put the money, do you go even between ICE and BEV? Because these are two different development streams, or two different manufacturing processes. In some ways, they're different supply chains. There's all of this. So where do you invest? And then we went back into the Paris Accord. Europe had more aggressive standards. China went the way that it went. We went the way that we went. Wall Street that went. And so everybody's like, okay, well, now I know. Well, now I have the answer. I prioritize BEV. All got ahead of the customer. In a lot of ways. So it was logical kind of what happened when it did, but it did need to settle down. And even when that was happening, I tried to remind people that it's a 20, 30-year process. It's not a 5 to 6 year process. Even getting vehicles that are more affordable and getting them in the pipeline into smaller segments. Most technology starts in luxury and filters down. Not all, but most. And so this is logical that this happens this way, and it was going to take time. You can't do it in 4 years.
Yeah, and it's any new technology, right? You have that adoption curve, right? It's not linear. We're going to have ebbs and flows, acceleration, deacceleration. I think what's going to be interesting to see over the next few years is what manufacturers, if you look at which manufacturers have a multi-portfolio alternative powertrains, definitely Toyota, we know, leads in hybrids, gas hybrids, and you have Honda. And Hyundai actually has a pretty balanced, if you look at all the propulsions, I think they're well positioned. But I think it's going to be really critical for the manufacturers to adjust. And I know they're trying to do that with hybrids in this transition to full electrification, but it takes time, right? And so it'll be interesting to see who kind of leads in the next year.
So we have two questions in the chat before we move on to the conversation about tariffs. The first one is, do you envision a situation where the automakers might be kind of required by the market to develop two different organizations, one focused on combustion engines, primarily for the US, and one for EVs focused on Europe and Asia? Do you see them bifurcating their business structure for the two different technologies?
I don't.
I think it's a, go ahead.
Okay. I don't see. I mean, we Ford have the different one. I think I think what we're going to continue to see is collaborations. We're already seeing that with OEMs partnering on different powertrains, different models, and so I don't think from a cost perspective that's going to happen.
Yeah, I would agree. There's still enough about the vehicle that's shared, and it doesn't seem to really have made a big difference to formally split those two organizations. So I think they're going to keep as they are. But you're right, collaborations are interesting and targeted collaborations more so than a lot of consolidation.
Yeah. The other question we have is, we have a lot of people went on to buy an EV on a lease, got pretty good incentive to do that. When their lease is over, do you expect those individuals to go back to another EV? Would they purchase their EV when the lease is over, or where do you see that stickiness? Did a lot of customers get into leasing an EV because of the economic incentive of doing so? Or will they just want to get an EV and will they stay with an EV going forward?
I think they're gonna go, I mean, I think we do an EV adoption study, and I should have had the stat right. I think it's over 60% that said if they bought or leased an EV, will buy their next vehicle will be an EV. So I think they're definitely gonna have a high percentage of people that once they have an EV, they experience it, they have a good experience, they're gonna want to get a new one.
Yeah, I think our loyalty data is showing something similar in there. I did not look at those numbers before I got on this call. But somewhere in that 50 to 60%, and even if it's 60%, coming back for a BEV, keep in mind it's 40% who don't. So
Right.
that tells you that the market still, consumers are still going at their own pace, and the BEV is doing a lot for a lot of people, and all of those exposures and all of that experience is going to continue to increase it. But there's still some that are, it's not a 90% rate, it's more like 60%. So there's opportunity for growth in EVs because of that, but there's still, it means gas is not going to go away anytime soon.
Kind of the mantra of TEI's entire approach, different strokes for different folks. We need to have the technologies and the vehicles for every person, every type of person, every needs case. They're all different. That's why I love the idea of having a great collection of electric vehicles out there for those who want them, and a great collection of combustion vehicles for those who want them, and a whole bunch of options. Options are always good. All right, so let's turn
expensive, John.
I know they're expensive. Everything's expensive, though. I mean, I don't know of any vehicles out there that aren't expensive. So at least not the ones I'm interested in. So let's, I forgot this one here. That's for the next paragraph. We'll come back. So tariffs. Stephanie, you're going to walk us through some of the tariff stuff, and then we'll go back to the last slide I just skipped over.
I'll go a little high level with this because we've been talking about this all year long. We were finally at a point now where key automotive trading partners have a settled framework that's in play. Again, it's a framework, it's not a final, and there's always that little bogey out there that if something goes wrong, it could change. But where we're at now is at least a stable position. It's high. It's not where anybody really wants to be. We're going to see a bunch of strange things happen on the steel and aluminum. And with the fuel economy regulations coming lower, there's one little side effect that we think is probably going to happen a little bit, and we're going to see more steel in cars and a little bit less aluminum, and things like steering columns, like suspension knuckles and things like that, where you might find a scenario now where the fuel economy standards are lower, so you're a little bit less worried about weight because you're a little bit less worried about getting every little grounds that you can, and the steel version is cheaper than the aluminum version. They're both being tariffed to heck, but you may make different choices in that regard for some vehicles. Automakers seem to be handling some of the tariff costs by spreading them globally, and raising prices in markets that aren't necessarily affected by the tariffs, so that they don't necessarily have to raise prices as much in the United States. And throughout 2025, automakers were super cautious about how much they increased prices relative to tariffs. And we're just eating them, partially because of the uncertainty of not knowing where it was going to really sit, and partially because it's just a big jump to put onto consumers, and we're already having affordability issues. So working through all of that. For 2026, the elephant in the room is USMCA. There's not a clear direction of how that will work. Our forecast assumption, because we have to have one, in large degree, is that we do think that however it shapes out, the effective tariff rate will end up, or the tariff rate will end up about 12% between US, Canada, and Mexico, and getting vehicles and parts into the United States. We don't know yet if compliance is still going to be an issue in terms of a three-party agreement, or if it's going to be two bilateral trading agreements. There's a lot of things that are still out there. And that one not only affects vehicle pricing for consumers, it affects the supply chain. We have a North American supply chain that was developed over 30 years. If you look at Canada and the US trading and having a free trade agreement for 20 years before that, there's a lot of depth within that, and finding a way through to secure and protect as much as you can, while recognizing that the administration is still going to go for a high tariff scenario. I don't see that going away. That's the big bugaboo for 2026, is how is that going to shape up? Consumers might not be exposed to all of it, but automakers will be. So that's the big deal for 2026 on that. Up until we get that solved, we're at least in a stable-ish environment. China negotiations got kicked down the road till November, so we're not expecting to see any change in that. Late last week, early this week, Mexico decided to enforce its a new tariff on anybody who's not a free trade agreement partner with Mexico, which is going to have an impact on them, and it slows down the potential for or changes the dynamic a little bit. It would encourage Chinese automakers to invest in plants in Mexico, which is going to come into a different environment as well. So we do still have a high tariff environment, and of course, you could look at it and think that that one of Mexico's reasons for going ahead and moving forward with this would theoretically be because the U.S. would be appreciative if they make it more difficult for Chinese imports.
Any other comments, Stephanie?
I think the only thing I'll add is it'll be interesting to see what kind of decontenting. I might not be using the right terminology, but like Tesla's a perfect example, right? They launched the new Model Y, Model 3 with less features, it's lower price. So we might continue to see some of that. And then also like some of these more vulnerable models that are lower price, but are built out of the country, with those tariffs, are they going to reduce? Are they going to go away, which are still in place? And what does that deal with production? So, because it takes time, once again, to move things to the U.S. to build them. So that's the other thing to kind of interesting to watch in the next year.
Agree, 100%. The trim mix is going to change. We've seen that a little bit. There's a couple of Audi models that they looked at it and said, well, we're not selling enough of the base model, so we're going to drop the base model. So effectively, you see a high price increase on A3 and Q3, I think, because it's a higher price of entry to get in. But the model that they dropped wasn't the one that was being sold. So effectively, you're not really hurting your affordability of that vehicle if you were selling 3% of the base model anyway, and everybody was in that other space. But we will see model content changes. One example earlier was Ford lowered one of the trim levels for the Maverick by a couple $100, but they moved the power sliding rear window from standard to optional. So we're going to see things like that come through, and we're going to see the magic is making sure that you have the right content in the right space that consumers want to pay for. And it could, in some cases, mean pulling some content out. In some cases, it'll mean changing the model mix entirely. But I look at that too, and whether it's tariffs or whether it's a different cost input, adjusting your trim mix, adjusting your option mix, adjusting what you're putting on the dealer lot is something automakers go through every year. This isn't a process they don't understand how to do. It's accelerated. It's a little more difficult with this pricing environment, with the tariff environment, but it's something they sit down and do every year. You're like, even if it's not a major model year change, does this LE package work? Do people seem to want this feature over here? And they move things around. So some of this are things that automakers tend to do. It also makes it very, very difficult for a consumer to say, well, is it more expensive than it was last year? What is the real price comparison? In some respects, it doesn't matter because you can't go back in time and buy what it was last year. So you just have to deal with the price in front of you. But it will be, it's not going to be easy for a consumer to be able to pull out. There's not going to be a tariff line that a consumer can say, it's $500 more because of a tariff. You won't be able to find that.
Okay. Let's move on to the last section. I think, Stephanie, I zoomed over your last slide here, but I want to talk about global stuff. Clearly, we are focused so much living here on what's going on in Washington and the U.S., but it is a global market, as the tariff discussion demonstrates. We look at China, we look at Europe, we look at Canada. It's just a completely mixed bag. So when you look at global dynamics, what do you see when you think about the stuff outside the U.S.?
I think of China. You look at, definitely you see on this chart, I think the global will have over 20 million battery plugins. 1 in 4 will be one of those, like, and that's significant growth from like 5% a few years ago. But definitely China is leading that. You know, they're exporting, I think, 6 million vehicles last year, and they're going into these emerging markets. So we're actually starting to see an uptick in EV penetration adoption in these emerging markets like Thailand. And then I think also the thing to point out, similar to the US, we've been talking about CAFE, our IRA. The EU just, you know, they're going to be proposing to ban or to make the ban on ICE vehicles to 90% instead of 100%. So I think we'll continue to see that. And also similar to the US, like in Europe, it's different. You look at Norway, right? Huge EV adoption compared to other parts of Europe. But definitely, I think policy is going to continue to change the adoption timelines. And definitely, I think China is taking advantage of being able to export all these EVs to other parts of the world and gain market share. And it's interesting, and we know there's a lot of reasons why China can build a lower priced vehicle, right? Labor costs, they have vertical integration, they have incentives. The other thing that's interesting, they also have a very short product life cycle. They can get something within 18 months. They went into Mexico with pure battery, realized that plugins were going to sell better. So they quickly were able to adapt and started selling those. So that's the one thing I think with China is their ability to be agile and to be, you know, quick at introducing new models across the world. But definitely, I think once again, we're moving towards electrification. It's going to be, timelines are shifting. It's going to vary even within country, depending what's going on, the infrastructure that's there, the demographics, the education. It's all going to be part of the adoption.
I mean, I think that's so important. We sometimes get so caught up what's going on within the US borders, but if the global market is moving, the automakers have to pay attention.
Yes.
And that changes their production strategy, that changes their investment strategy. And while it may seem like, you know, the focus is on the US because that's where we live, those automakers are looking at every single market.
And they have ventures, right? They're partnering with Chinese OEMs and, you know, developing vehicles and stuff like that. So I think we'll continue to see that as well.
Yeah, that's always been one of the reasons that even whatever we do with CAFE, automakers are going to continue to develop that because they have to have it elsewhere. And I think that the European Union decision is really important, actually, because their market is in a difficult position right now, and it wasn't going to be able to make it. And when we look at China, yes, all of those things that we said are true. You know, they're moving faster, they're able to do all of this. But they've also got a market that's partly subsidized in terms of the consumers by more incentives and subsidies and trying to, you know, buy old cars and get new cars on the road in a much more aggressive way than we're seeing in other markets. And we're also in the middle of a price war in China. And so there are some underlying things happening that are keeping the market high that we've seen in other markets aren't sustainable for a very long time. I think that suggests not that China's going away or those products are bad, but I think that holding that up and saying their growth here, it means that this is what everyone else needs to do and they're leading. There are still some underlying factors that are risk factors with what's happening within that market. And I think the risk factors in Europe, in the high costs and in the difficulty they're having as well, and then seeing what's happening here, I think there's some risk factors in trying to push it too fast. And I think that's kind of where we're at. It doesn't change the trajectory. But I think that we need to be very cautious and concerned about what's happening in China and how those automakers are developing. But we need to look at it critically as well.
You're right. The overcapacity issues and like, I think there's over like, what is there, over 150 OEMs?
Yeah,
at some point, right? There's way too many. A lot of them are going to go under, and definitely the overcapacity is an issue right now.
Yeah, that's some of the export stuff. Yes, they're able to get into market share and able to expand and grow globally in a different way. But part of it's because they've got capacity that they don't need, and you've got the plant. And so what do? You send it someplace else. There isn't a trick in the book that they're using that isn't been used someplace else, somewhere along the line.
Yeah, so we do have a couple other questions in the chat. The first one is going back to CAFE. Question on how CAFE standards have functioned historically. When you say the industry could benefit from more relaxed rules because they will be able to sell more high margin trucks, is that because the automakers were limiting production of trucks out of the need to meet CAFE standards and not face penalties? Or will the changes mean higher auto industry profits?
It's a complex question. I think that what the changes do enable automakers to let consumers determine the pace of adoption. Where if you're building to meet the regulation rather than to build demand, it's a difficult position to be in. If you lower the fuel economy standards, then you can build to demand. Does it make vehicles cheaper down the road? Not exactly. If you've got more margin in an ICE vehicle than you've got on a BEV vehicle, then your margins look better if you sell more. I mean, that's pretty obvious. But when you look at the cost of complying with the current regulations and you don't have that cost, that vehicle's not on the road yet. So it sort of does, but it sort of doesn't. It's like saving the money you don't have. Like I'm planning to spend money, and now I don't have to spend it. Doesn't really change the cost when you get there, if that makes sense. I think really there's a lot of just market alignment that is going to be helpful from those regulations. And again, they had to change, maybe not quite as aggressively as the Trump administration did. I'm not saying what they should be, but they weren't going to be able to be held to where they were. Battery cost, as we talked about earlier, is not coming down as fast as it was projected to come down. There's still battery technology being developed. Solid state's really promising, but now we're talking maybe 2030 29, 30 before you have solid state technology that's scaled up. So some of those bogeys still are down the road, and we weren't able to make it. So it makes it a little bit better, but you still have to develop the technology, as we were talking about. So you can't just turn off your BEV development and say, I'm going to ignore that. It's still a tricky situation. It takes one of the factors and it makes it a little bit easier, but it doesn't turn a complex situation into an easy one. It doesn't mean, oh yeah, we're good. We're just going to sell big SUVs and make money and everybody's happy. That's not the answer.
The last question is also associated with the efficiency standards, but related to the export of combustion vehicles to the United States. The U.S. lightens their efficiency standards. How is that going to relate to the trade relationships of us exporting vehicles to other markets if we are not aligned on efficiency standards? Could that be a factor in manufacturing decisions that create greater uncertainty for U.S. vehicle exports?
I think it's a good question, but I think when we look back a little bit, our exports tend to be to Middle East and some other areas. We're already exporting to markets that have tighter restrictions than we do. We're already having to adjust powertrains in that space. So I don't think it changes that dramatically because it's something we're already having to work through anyway. So I don't see that's going to be a big problem in the change. It might make it easier in some respects. I don't know. So we'll see how that shakes out. The other half of that, and in the tariff conversation, there's an intersection here. Most of the agreements also say that the U.S. or that the neighboring countries, the European Union, Japan, and South Korea, and doesn't say it about the UK, but the other three, it's written in that they will accept U.S. certification and U.S. safety and emission standards. So that's the part that can be helpful because they've agreed that you don't have to meet the regulation in order to export the vehicle. So you don't have to homologate it, you don't have to recertify it, you don't have to necessarily be in compliance. That's what they've said, but actually working that through the system is going to take a little bit of time. And still, like a big V8 engine doesn't suddenly get more attractive in Europe because we shipped it there. So you know, it's still, there's a little bit of opportunity there, but it doesn't suddenly change the makeup of these markets. If you look at Japan accepting the vehicles doesn't suddenly make our vehicles make sense there. Some will, some won't, and some of those challenges are very market specific in how people use their vehicles and what they expect. Safety standards are going to be an interesting one as they try to say they're going to accept them, because there's reasons for different safety standards. It's not, you can look at US and Canada, and Canada, you know, just being that much further north has different lighting situations and different conditions that they have to worry at, and daytime running lights are a result of Canada needing to have light in different conditions than the US have. So I think it's very easy to write into the document, you're going to take it, but I don't think it's going to handle quite as efficiently, and it does not inherently create consumer demand.
Stephanie, any comments on those two questions?
No, agree with everything Stephanie said.
Well, guys, we are at the end of the hour. Thank you so much. This was a fantastic conversation. Really appreciate your input. And for those of you who joined us, thank you for joining us. Clearly, Stephanie Brindley and Stephanie Valdez Streaty are wealth of knowledge. So you have questions and want to reach out, their emails are on the last slide I showed. Please reach out. I call upon them and their colleagues all the time to help us kind of figure out what's going on in the market. So again, thank you guys very much for joining us. Thank you all for joining us as the audience. Have great holiday season, and we will be in touch soon. Thanks, everybody.
Thanks, everybody.
Thank you. Happy holidays.
All right.